Imagine I am holding a weighing scale and I have equal number of coins on either sides. What will happen if I start adding coins on just one side more and more? The weighing scale will automatically start tilting towards one side, isn't it? That is exactly what a put ratio spread does. It tips the odds in your favor, but only if you are confident. Hi, I am Pranav VK, your options trading strategist here at Stockshaala by Kotak Securities. In this video, we are going to cover a strategy called as put ratio spread, which will help you amplify your returns with skewed risk. A put ratio spread is basically a bearish strategy where you buy one higher strike put and you sell two or more lower strike puts. So let's understand the strategy using a payoff diagram. Here we have the payoff diagram of a put ratio spread. So as you can see, this is built using a combination of one buy, that is 25,600 put option, as well as selling two 25,400 put options. At this point, I am considering Nifty to be at 25,600 and my view is mildly bearish. So that is when this strategy is going to make sense. A very good feature of the put ratio spread is that in case you're wrong on the positive side, then you're going to lose very less. But at the same time, if your view is right, then your profits keep increasing up to a middle point, after which it starts decreasing. But if the market falls too much from where you have started the strategy, then you might start having unlimited losses as well. So it's important to have stop losses in place so that you have the right kind of risk management in place. This strategy is best used when you are strongly bearish, but not to the extent that you're going to start having unlimited losses as well. You also want the IV to be high so that the premiums are inflated and you're going to benefit from the theta decay. You will be executing this strategy when you want a higher reward compared to simple put buying. And most importantly, you'll be executing this when you expect the market to fall moderately and not have a complete crash. Now let's put some real numbers to the strikes that we've already chosen to see how this strategy works. So let's start with assuming that I bought the 25,600 put option at rupees 60, which means I paid rupees 60, and I sold two of 25,400 put options at rupees 20 each, which means I have received a total premium of rupees 40. So in this case, it was a net debit scenario because I have paid rupees 60 and I've received only 40. So the net debit is rupees 20. Since it was net debit of rupees 20, so that is the loss what you see here. That is the maximum loss I'm going to bear in case the market goes above and beyond the level that I have in mind. Now, if certain scenarios where instead of rupees 20 each, I will be receiving rupees 40 each, for example. In that case, it will become a net credit where I will be receiving rupees 20 as net credit. In those scenarios, this graph is going to change in such a way that you are now going to have profitability right from the start. Now let's calculate the maximum profit for this strategy. You're going to get the maximum profit if Nifty expires at 25,400 PE, which is our lower strike. So that is when you are going to have this maximum profit, and if it expires at that level, then this entire premium that you had over here is going to expire worthless, and your 25,600 PE is still going to have some value. So in that way, you're going to be having maximum profits. So let's assume, when the strategy started, the Nifty was at 25,550, and as the market started falling to 25,400, this 25,600 PE started gaining more premium. So rupees 60 now has added additional 150 rupees. So that would have become rupees 210. Along with that, your 40 rupees that was here in terms of premium, that would have become 0. So you are getting an additional 40 rupees as well. So the total profit in this case would be 250 minus the initial premium that you have paid, that is 60. So that will be nothing but 190. So that will be your overall profit. Now let's calculate the break-even point. So for the ease of calculation, we will assume that instead of 20 rupees, we have received 40 rupees each, which means we have a total net credit of rupees 20. 80 minus 60, so that's going to be net credit of 20. So the formula goes something like this. It is nothing but lower strike minus the difference in strikes minus the net credit. So the lower strike is 25,400 minus difference in strikes is 25,600 minus 25,400, that is 200, minus the net credit of 20. So that is nothing but 25,400 minus 180. So that is going to be 25,220. So 25,220 is going to be our break-even point for this strategy. So if the strategy goes below this, then you're going to start making a loss. So if the market starts going below 25,220, that is when this strategy will start making a loss. Another important point to observe is that earlier we also saw that if there was a net debit, then there was a loss that was there in this strategy, right? But most times you're going to have a profit because it's going to be net credit. But in case it is going to be a net debit, then you'll have to adjust for it accordingly. So far we have understood what exactly is a put ratio spread, when to use them, and how the payoff diagram looks like. Now let's understand the risks associated with this strategy. If the market crashes heavily after you have entered into this strategy, then the losses are unlimited. This strategy is not suitable for beginners and should be traded with extreme caution and stop losses. Alternatively, you can also convert this strategy into a broken wing butterfly, which we will be covering in the upcoming videos. Now let's take a real market example to concretize your learnings. Assume that Nifty is at 19,550 and IV is at 21%, and you're expecting the market to fall to 19,500. So what are you going to do? You can go for a put ratio spread. Let me show you how. Since we know that 19,500 is where Nifty is going to go, and we know that for a put ratio spread, the maximum profit is also where you do the double sell, right? So what we're going to do is we're going to buy 19,600 PE and we're going to sell 19,500 PE into twice. So here, let's say the premium is rupees 60 and let's say here the premium per lot is 40. So overall what is happening is we are paying 60 and we are gaining 40 into 2, that is 80. So it is 80 minus 60, that is 20 rupees, which is our net credit. And the maximum profit is also here at 19,500. And now to calculate the break-even point, like we discussed the formula, let's go with the lower strike, that is 19,500, minus the difference in strikes, that is 100, minus the net credit, that is 20. So that is nothing but 19,500 minus 80. So that is going to be 19,420. So this is going to be our break-even point, 19,420, below which our loss is going to be starting, and it is unlimited beyond this point. So let's summarize what we have learned so far. We understood that a put ratio spread is created by a combination of buying a higher strike and selling two lower strikes. More often than not, the sell options is going to give you higher premium rather than what you have paid. So it is going to be a net credit. We also know that the break-even point for this specific strategy is going to be the lower strike minus the difference in strikes minus net credit. And the maximum profit is going to come when the market ends at the lower strike. The best time to execute this strategy is when you are moderately bearish on the market as well as the IV is high. Remember that the reward is better than a naked put, but also remember that the risk is unlimited in this case. A ratio put spread gives you smart rewards for smart traders, but don't make your overconfidence make you lose your entire capital. Let me know in the comment section what you felt about this strategy and share it with your friends. You're watching Stockshaala by Kotak Securities. I am Pranav VK and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.